Law firm owners, if you've ever had a CPA tell you, great year, you made a solid profit, while you're staring at an almost empty bank account, this one's for you. Today's confession is about a firm that showed over $200,000 in profit on the P&L and still almost missed payroll. Names and details changed. The math is real. From the outside, this firm looked fine. 3-attorney shop, steady pipeline, revenue a little north of $700,000. The owner sent me his year-end financials with this line. My CPA said we made about $200K, so why does it feel like I'm broke? When I looked at the P&L, he was right. On paper, it said revenue about $720, expenses roughly $500, net income around $220. That should feel great, but here's what was actually happening in real life. There was about $14,000 sitting in the operating account. He was behind on a couple of vendor bills. Next payroll was making him sweat, and he had a 5-figure credit card balance creeping up again. So the obvious question, if we made, $220K, where'd the money go? This is where most owners think their CPA or bookkeeper must be lying, or that the profit is fake. It's not. Profit is just answering a different question than your bank balance. Profit says, did the business model work this period? Cash says, can you write checks today? To solve this, I walked them through a simple cash map. You can picture this as 4 big buckets where profit disappears. Bucket number 1, taxes. There was no planning or anticipation of taxes. Every quarter, the CPA would say, you owe $25K, and he'd nuke whatever cash had built up. Over the year, more than $70,000 of that profit went straight to the IRS. Perfectly normal, completely unplanned. Bucket number 2, owner draws. The P&L showed about $120,000 for his salary, but he'd also been taking random extra draws whenever the balance looked right. Those extra pulls don't show up as an expense on the P&L. They come off the balance sheet, which means the report still says $220K profit, but another $40 to $50K had quietly walked out the door into his personal account. Bucket number 3 is debt and big purchases. During the year, he paid down a line of credit and bought new computers and some fancy office furniture. Loan principal payments and those bigger assets don't hit the P&L either. They burn cash now and get spread over future periods by the accountants. It's the right accounting treatment, but if you only look at profit, you miss how much cash left the building. And finally, bucket 4, work you did but haven't been paid for. This one hurts the most. He had tens of thousands of dollars sitting in unbilled time and slow pay receivables. The P&L had already counted that as revenue because the work was done and billed. The bank account hadn't seen a dime of it yet. Add up these 4 buckets, taxes, extra draws, debt and big purchases, and slow collections, and, surprise, the missing $200K wasn't actually missing. It was just sitting in other places than his operating account. Once he could see that, the panic dropped. Then we did the real work. 1, we started moving a fixed percentage of every deposit into a tax account automatically. Number 2, we put his owner pay on a boring, predictable rhythm and stopped the random extra raids. 3, we listed loan payments and big purchases in a simple 13-week cash view so there weren't any surprises. And number 4, we got serious about billing and collections so profit didn't sit in accounts receivable purgatory for 60 to 90 days. Same firm, same revenue, no magic new marketing, just finally understanding why profit and cash were telling different stories. Here's your takeaway. If you've ever said, we're profitable, but I never have any money, your problem isn't that the numbers are lying. It's that you don't have a map from profit to cash. In the Trust and Books checkup, this is exactly what we build. We take your P&L, walk line by line to show you where the money actually went, and give you a simple weekly cash view so you're not guessing before payroll. Profit is an opinion. Cash is a fact. Until you can connect the two, your firm will keep feeling broke no matter what your P&L says. Hope that helped. And now you know what time it is. Mailbag time.
Mailbag.
As always, these are real questions from real people. Chris, my CPA says we made around $180K in profit last year, but the bank account never felt like that. I'm not accusing anyone of lying. I just genuinely don't see where it went. Is there a simple way to figure out where the money went at the end of the year? Yes, it's a great question. So your P&L, when you look at the profit and loss statement, it shows you how much money you made over the expenses that you sort of incurred in providing the service, in getting the service, marketing, advertising, all the expenses that you incurred in the course of business. But the P&L doesn't show you other areas of cash outlays. And this is where your money disappears to. All right. So number 1 is going to be taxes. Okay. If you're paying quarterly taxes, let's say you write a $10K check every month for your quarterly taxes, that is not an expense. It is sort of money out of your own personal pocket, even if it comes out of the business. So that money goes away, even though it doesn't show up on the P&L, and it doesn't reduce your profit. That's number 1. Number 2 is going to be accounts receivable. Okay, so if you've billed a lot of work, but you haven't received a check yet, that money will show up in your P&L as revenue, but it may not actually be in the bank account. So the profit that you're showing in your bank balance may not be the same. Okay. Number 3 is going to be capital expenditures and debt pay down. Okay. When you pay the balance of your credit card debt that's been building up for months and months and months, that money goes out, but that's not reflected on your P&L. When you buy assets as a law firm owner, let's say you buy a bunch of computers, you may not book that expense in month 1. You may carry that out and depreciate it over years. So the money goes out, but you haven't booked the expenses yet. So those things don't show up on your P&L. The 4th and final one is where I see the biggest problems, particularly with law firm owners in that $300K to $1 million range, is owner draws. Okay, if you're taking a salary, that will show up on the P&L if you're an S Corp. But the extra that you take out, when you think there's a little here, there's a little there, you need some money for a vacation or whatever, you take it out. That money does not show up on the P&L. So if you're taking an extra $5K out a month, that's $60K that's out of the firm, but does not show up on your P&L because it's not an expense. Okay, so those are kind of the 4 areas where the money can go. You can track that internally as you make these withdrawals. What I would prefer to do is set up systems so that you're doing things the right way and not left at the end of the year wondering where all the money went. Question 2, you talk about having a buffer so you're not panicking before payroll. For a small firm like 2 to 3 lawyers, a couple staff, how much cash should we be aiming to keep in the operating account? So this is a perfectly good question for a perfectly good lawyer answer, which is it depends. All right. It really depends on your risk tolerance. I know you law firm owners tend to be less risk tolerant. You don't want risk. So I would say in that case, you probably want to have at least 2 months of operating expenses in the bank, maybe 3 months. The minimum I would say is 1 month. Okay. Are you likely to have more than one bad month in a row opposite some sort of like world events? If you're an established law firm, probably not. So if you have those dips, 1 month in the bank probably get you through those. You'll be able to figure out what happened or what's going on, fix it, and move on from there. So 1 month typically will prevent panic. If you're more risk averse, 2 months. And if you get over 2 months, that money's kind of dead. It's not being used properly, in my opinion, but you do you. Question 3, Chris, my bank keeps offering me a business line of credit. Cash gets tight a few times a year, especially before big cases settle. Is it smart to use the line of credit to smooth those dips, or is that just asking for trouble? Okay, good question. There's a little bit of nuance here. The first thing that I'll say is this. In my opinion, anytime anyone offers you credit, you should take it. Okay, that doesn't mean you have to spend it, but you want to have the ability to use that credit if you need to in the future, like just in case of an emergency. Okay, so if your bank calls you and said, hey, we'll give you $50K line of credit, just take it, okay? If you don't use it, typically you don't have to pay any interest on it. You don't have to do anything. But when you don't need credit is often when it is offered. And when you do need it is often when no one's around to give it to you. So if you have an opportunity, I would take that credit, even if it just sits on the shelf. Now, when to use it? Your question is a perfectly good scenario when I would use business credit. If you are a PI law firm in particular, you often have to outlay expenses and spend money over time before that settlement check comes in. Using the line of credit for that is super helpful, and it's really what lines of credit were designed to do. You have a gap between work and money, and you need to fill that gap often with a line of credit. When the settlement comes in, you pay the line of credit off, you keep the rest as your profit, and you're good to go. When it's dangerous to use a line of credit is when you are funding lifestyle. Okay, we're not taking owner draws from the line of credit. If you are buying sort of frivolously, or if you're not charging enough, if your business is not profitable enough to actually make money and you're sort of just hemorrhaging down and down and down with this line of credit, that's also a recipe for disaster. So I love credit. I want you to get credit. I want you to use credit, but I want you to use it in the right circumstances, and I want you to use it wisely. We have about $40K in business credit card and line of credit debt for the law firm. Question 4, by the way. Part of me wants to throw every spare dollar at it. The other part of me panics when the bank balance is low. What comes first, killing the debt or building a real cash cushion? Great question. And not everyone's going to have the same answer on this. Here's what I will tell you, what I would do, what I would suggest, and what I have done in my own business. Okay. So you have this debt. It kind of is, it's eyeballing you. It's talking to you. You want to get rid of it. I totally get that. But if you throw all of your money at this debt and something else comes up, what happens? Well, I'm going to call it the death loop. Okay. So you pay it off, emergency, you rack it up. You pay it off, you rack it up. So what I would prefer that you do is take that extra money, build a bit of a nest egg. Okay. You want to have at least a month of operating expenses kind of tucked away for emergencies. I would build that emergency fund up and maintain your debt payments over time, pay whatever you're supposed to pay. And then once that cushion is built up, then I would start to throw a little bit of extra money at your debt balances, your line of credit, your credit cards, stuff like that. Try to pay those down faster. And then, by the way, one more thing that I would do, if you can, if your business is healthy, you in a law firm, you probably can do this, is once that happens now, every month when you run payroll or when you do whatever, I would pay the statement balance off from the previous month for the credit card. Okay, so you should have that money coming in regularly now. Pay off the debt as you incur it. You have your safety net, and the rest goes right in your pocket. All right, hopefully that helped. That's great. Mail time is over. Let's go to Tax Corner. Let's go. Welcome back to Big Bird's Tax Corner, where small law firm owners learn how to legally pay less in taxes and actually keep more of what they earn. Today's topic, depreciation in plain English. All right, let's start with a good old fact pattern to just show you what it is. Let's say this year your law firm buys $12,000 of computers and furniture for the firm. From a cash standpoint, what happened? You bought this stuff, you wrote a check, your bank balance then dropped by $12,000 today. But on your P&L, your accountant probably does not show a $12,000 computer expense in 1 month. They treat it as an asset and spread the cost over its useful life. If they are good for 3 years, you'll receive about $4,000 of depreciation expense per year. So in year 1, your P&L is not going to show a $12,000 expense, but a $4,000 depreciation expense. Years 2 and 3, another $4,000 each. But in real life, your bank balance went down the full $12,000 in year 1. This is why depreciation is confusing. It reduces profit on your P&L a little bit each year, but the cash already left the building up front. Why does this matter? First, when you look at your P&L and see depreciation, remember that's a non-cash expense today. The cash went out when you bought the thing. Number 2, when you do a where did the money go review, big asset buys need to be on your list. They're one of the reasons your bank balance can feel tight even if this year's profit looks fine. Number 3, tax-wise, depreciation is just the IRS letting you deduct the expense over time. Sometimes they let you accelerate it and take more in year 1. In fact, with computers, you can do that right now. That reduces taxable income, but it doesn't change the reality that the cash already left. So when you buy something big for the firm, plan for the cash hit up front. Understand the profit hit will show up slowly through depreciation. Don't confuse a lower profit number with mystery missing cash when really you just bought expensive toys for the office. That's it. Okay, that is depreciation in a nutshell. Okay, in our trust and books checkup, when we walk through your profit to cash bridge, we always look for these big purchases. Once you see how depreciation works, the P&L stops feeling like a magic trick and starts feeling like a scoreboard you can actually use. That's it for this week's Tax Corner. Real quick, if you're a law firm owner doing between $300K and $1 million a year and you're not confident your books and trust account would survive an audit, I'm offering a free trust and books checkup for your firm. We'll review your setup, flag any real risks, and outline a cleanup plan. To book yours, go to bigbirdaccounting.com/checkup.